Are you ready to take advantage of the next big market shift? With interest rates dropping, how can you position your portfolio to capture the gains while minimizing risk? In today's video, we're going to dive into one of the hottest topics in investing right now, rate cuts. With the recent rate cuts from the Fed, we're seeing major shifts across several sectors, from real estate to small-cap stocks. But how exactly can you benefit from these changes? We'll explore how different sectors react to rate cuts, which ETFs are positioned to thrive, and how you can structure your portfolio to make the most of the current market environment. Whether you're looking at real estate, small-cap growth, or large-cap value, I've got you covered with actionable strategies that you can apply right now. Let's jump in and see where the best opportunities are hiding for 2024 and beyond. But before we get started, make sure to hit that like button, subscribe for more insights like this, and drop a comment below with your thoughts. Let's start with one of the sectors that stands to gain the most from falling interest rates: real estate. Historically, when interest rates decrease, borrowing becomes cheaper, making it easier for individuals and companies to invest in property. This dynamic creates an opportunity for real estate investors to benefit from the rising demand and appreciation of property values. But here's the thing: you don't need to buy physical real estate to take advantage of this trend. There are easier, more flexible ways to get exposure to real estate, like REITs, real estate investment trusts, and REIT ETFs, which give you the opportunity to invest in real estate with less capital and risk. One option for those looking to invest in real estate without the hassle of property ownership is REITs. For example, VICI Properties. VICI is a REIT that focuses on entertainment and casino properties, offering a unique way to diversify your real estate exposure. Another solid pick is O Realty Income O, which has built a reputation as a reliable REIT for consistent dividend payments, making it attractive for income-seeking investors. Now, if you're looking for a more diversified approach, REIT ETFs offer exposure to a broad range of properties and sectors without the need to pick individual REIT stocks. One of the top REIT ETFs in the market is the Vanguard Real Estate ETF, VNQ. VNQ boasts total net assets of $37.133 billion and trades at a market price of $98 per share. It has a low expense ratio of 0.13%, making it a cost-effective option for long-term investors. VNQ's dividend yield stands at 3.36%, providing a steady income stream, and its 10-year average annual return is an impressive 6.30%, reflecting solid long-term performance. With 155 holdings across various real estate sectors, VNQ gives you exposure to data centers, healthcare facilities, apartments, and retail properties. Year-to-date, VNQ has returned 9.31%, and over the past year, it's delivered a stellar return of 31.17%, proving its strength in the current market environment. Another excellent REIT ETF to consider is the Schwab US REIT ETF, SCHH, which offers similar diversification at a lower price point. SCHH has total net assets of $7.285 billion and trades at a market price of $23, making it accessible to a wide range of investors. With an even lower expense ratio of just 0.07%, SCHH is one of the most cost-effective ways to gain exposure to real estate. Its dividend yield is a competitive 3.27%, providing consistent income for investors. Year-to-date, SCHH has returned an impressive 10.70%, and over the past year, it's outperformed with a return of 33.01%. SCHH holds 119 different REITs, including major players like American Tower and Public Storage, giving you a well-rounded portfolio of income-producing real estate assets. With interest rates falling, the environment for real estate investing is becoming more favorable. As borrowing costs decrease, demand for properties typically rises, which can lead to higher home prices and greater returns for investors. By investing in REITs or REIT ETFs like VNQ and SCHH, you can tap into this trend without the headaches of property management, while still enjoying steady dividends and potential capital appreciation. Whether you're looking for income or long-term growth, These ETFs provide a diversified, low-cost entry into the real estate market. Now let's shift our focus to small-cap stocks, which are positioned to benefit significantly from falling interest rates. Small-cap companies typically have a market capitalization between $250 million and $2 billion, and they often rely on borrowing to fund their growth. When interest rates fall, borrowing costs decrease, giving these smaller companies easier access to capital. This allows them to reinvest in their businesses, expand operations, and improve profitability, often at a faster rate than large-cap companies, which are already well established. Why are small-cap stocks particularly intriguing in this current environment? Simply put, small-cap companies are more sensitive to changes in borrowing costs. With cheaper loans and better access to financing, these companies have the potential to grow rapidly, offering higher returns to investors who get in early. As rates fall, we tend to see small caps outperform, especially in the early stages of a rate-cutting cycle. For those looking to invest in small-cap stocks, one of the best ways to get diversified exposure is through small-cap ETFs. A great option to consider is the Avanti's U.S. Small Cap Value ETF AVUV. AVUV focuses on small-cap value stocks, which tend to outperform in environments like this as investors shift from high-growth stocks to more stable, value-oriented investments. AVUV has more than $12 billion in assets under management and is actively managed, meaning it focuses on companies with strong profitability and solid value metrics. With an expense ratio of just 0.25%, AVUV offers a low-cost way to gain exposure to a wide range of small-cap value stocks. Year-to-date, AVUV is up 7.5%, and it has shown nearly 100% growth over the past 5 years, making it a strong performer in the small-cap space. Another small-cap ETF worth considering is the Pacer U.S. Small Cap Cash Cows 100 ETF, CALF. CALF focuses on the top 100 small-cap companies within the S&P Small Cap 600, based on free cash flow yield. This strategy targets companies that are generating significant cash flow, which makes them better equipped to weather economic downturns. Although CALF is down 4.4% this year, it has seen a remarkable 177% growth over the past 5 years, even outperforming the S&P 500 during that period. For investors looking for small-cap exposure with a focus on cash flow, CALF could be a compelling option. Small-cap stocks may come with more volatility than their large-cap counterparts, but in a low-interest rate environment, they can offer significant upside. By investing in small-cap ETFs like AVUV and CALF, you can diversify your portfolio while positioning yourself to capture growth as smaller companies benefit from cheaper capital and reinvestment opportunities. This is an ideal time to look into adding small caps to your portfolio, as they are poised to grow alongside a recovering economy. While small-cap stocks offer high growth potential, large-cap value stocks provide stability, especially in volatile markets. Large-cap companies with market capitalizations over $10 billion are well-established and often generate consistent revenue, making them safer bets during economic uncertainty. What makes large-cap value stocks particularly appealing right now is that they tend to outperform during periods of economic slowdown or market volatility, offering steady returns while carrying lower risk than high-growth or small-cap stocks. The reason large-cap value stocks perform well in these environments is simple. These companies usually have strong balance sheets, reliable cash flow, and pay out dividends. When markets are uncertain or fluctuating, investors often rotate into these safer stocks because they offer more predictability. Large-cap value stocks are less reliant on borrowing for growth and tend to hold up better during periods of tightening economic conditions, which is why they're considered defensive plays. One of the best ways to gain exposure to this category is through Vanguard's Value ETF, VTV. VTV is one of the largest value ETFs, with over $116 billion in assets under management. It focuses on high-quality large-cap companies that provide steady returns and lower volatility. The ETF has a very low expense ratio of just 0.04%, making it an attractive option for long-term investors. Over the past 10 years, VTV has averaged an annual return of over 10%, demonstrating its resilience and consistency in delivering value to investors. In addition to growth, VTV also offers a dividend yield of 2.3%, which adds to its appeal for those looking for income during turbulent market conditions. Year-to-date, VTV has risen 15%, and its portfolio is made up of some of the most stable and profitable companies across sectors like healthcare, finance, and consumer goods. For investors who want to prioritize both safety and higher dividend income, value-oriented ETFs are a fantastic option. Large-cap value ETFs like VTV help balance the risk in portfolios that are heavily weighted toward growth or small-cap stocks. They provide a steady dividend yield and are less volatile, making them perfect for investors seeking lower risk exposure without sacrificing returns. As we continue to see shifts in the market due to rate cuts and economic uncertainty, large-cap value stocks will remain a critical component of any well-rounded portfolio. By investing in ETFs like VTV, you can protect yourself against market swings while still benefiting from steady growth and income over time. These stocks are the cornerstone of defensive investing, providing peace of mind in an otherwise unpredictable market. While large-cap value stocks offer stability, it's important not to overlook the role of growth and innovation in your portfolio. Growth ETFs, especially in the tech sector, have been major performers over the past decade. Even as we see rate cuts benefiting real estate and value stocks, tech companies can also thrive in a lower interest rate environment due to cheaper borrowing costs. ETFs like QQQM and VUG offer exposure to some of the most innovative companies driving the next wave of technological advancements. Yes, these ETFs may be more volatile, but they provide opportunities for significant returns over the long term. The key is balance. Finding the right mix of growth and value to ensure you aren't too heavily reliant on one sector. Looking ahead to 2024, a diversified portfolio will be crucial for managing both risk and reward. A smart strategy might include 30% in large-cap value ETFs like VTV for stability and dividends, 30% in growth ETFs like QQQM or VUG for exposure to cutting-edge companies, 20% in real estate through RAT ETFs like VNQ or SCHH to capitalize on falling interest rates, and 20% in small-cap ETFs like AVUV or CALF to capture the growth potential of smaller companies. This kind of balance provides exposure to different sectors, helping you stay resilient through market shifts while benefiting from growth across multiple industries. To wrap things up, rate cuts create unique opportunities in various sectors. Real estate, small-cap stocks, and large-cap value companies are particularly well-positioned to benefit from these economic changes. And with a diversified portfolio, you can take full advantage of these trends while managing risk. Whether you're seeking the steady dividends of value stocks or the high-growth potential of small caps and tech, 2024 presents an exciting opportunity to revisit your portfolio and make sure you're set up for long-term success. If this video helped you, don't forget to hit the subscribe button for more insights into ETF investing. I'd love to hear your thoughts on the recent rate cuts. Are you planning any changes to your portfolio? Drop a comment below and let's chat. Thanks for watching, and I'll see you in the next video.